So our next question is, I have a large stock position with some massive capital gains. How do I manage this in my retirement portfolio?
Yeah. Okay. So, we're in Silicon Valley. So one of the things we've seen is large stock positions with large capital gains. Either somebody that worked at the company, and accumulated stock through stock option purchase program or what have you, RSUs, or they, just new people. I mean, for example, for me, my sister was graduating from college. She had two job offers, one for HP and one for this little company called Cisco. Had about 250 people in it at the time. And she asked me, with my background, to do some research on the companies. What was the viability and how did the stock look and those types of things. And so I looked into Cisco, and I was really impressed with what they were doing, and they were growing like wildfire. And I actually, recommended that she go there, and she did end up going there. And I bought some, and that part of the proceeds to pay for my house came from that Cisco stock purchase. Um, and so we've seen this a lot in our area. So I actually do have some strategy. Let me share a screen here, and I'll share. Let's look at like Apple, for example. Here, yeah, here we go. Okay, so here's the stock I run into all the time. Fantastic run. This is a daily chart for 5 years, right? So you can see what it did. I mean, really amazing. Kind of been running sideways since last September here, but great, great run. And so I have a couple of strategies here. Number one, I'm not a really big fan of like selling a bunch of it to diversify, just because I have seen the wealth creation that these pieces can do. And now a lot of advisors are running around say selling it, but there's also a conflict of interest. They want you to sell it so they can move it into something that they make money on. So I'd be very careful with that. What I try to take a look at is like, hey, this is like a fruit tree, right? So this is a tree that can produce for you, and if you treat it right and handle it right, it can continue to do that. And what you do want to do though is maybe pick some of the fruit off and harvest some of that fruit really every year. And so a couple of strategies, but first and foremost, when I'm dealing with a client like this, I need them to understand that even though Apple is fantastic, it just had a 54% increase in revenue. It is one of the greatest companies on the planet. It doesn't mean that it'll always be the greatest company on the planet. So, I mean, I'll give you an example here. Let me pull up GE. I've had a lot of GE clients over the year because they had a presence here. The plant where, nearby where I live here in Willow Glen was a GE plant. So this is GE over the last 5 years. And you can see it's actually had a little bit of a run here. But, the high was 33 and the low was $5. This is one of the greatest companies on earth, one of the first Dow components going back to the 1880s. And if GE can fall apart and have that type of a downturn, so can Apple. So basically, that's something I need people to understand right away, if possible, is just understand that Apple could fall apart, and it is possible, and you probably don't want to ride that all the way down, especially in your retirement and what have you. So I've got Apple back up here. Let me zoom in, just let's pick a 1 year period, and I'll show you one of the strategies. So one of the things that I would think about doing here is really just kind of selling small parts, harvest this fruit off of this tree. We're going to keep this tree, keep letting it do that. And it depends on how much this is, what's the total value, how much is it of your total net worth. But, maybe you're selling 1% of it a year or 5% or 10%. Kind of depends on your situation, your outlook. But the way to do this, in my opinion, is we do what's called a covered call. And so a covered call is a really fascinating concept. Basically, you go out and you sell a call, which means that you get money. So let's just say, for example, I sell a call here at Apple and I get $1,000. So I get to keep that. Now I have to pay taxes on it, which we'll talk about, but I get $1,000. Now I might buy one every 30 days. And let's just say that I sell a covered call at $140. I'll put an alert in here so you can kind of see, what I'm talking about.
Let me quickly stop you right
Yeah,
there. What's a cover call? Can you
yeah.
explain how that works?
Yeah, it is what you're doing is selling the right to somebody else to buy your shares at a, a certain price. And so let's just say this is around $140, right? Apple right now is at 127. You can see it's flashing. uh, and so what I'm saying to that person essentially is, I'm going to let you have, let's say 100 shares or 1,000 shares, whatever it is, at $140. And so if Apple climbs in this 30-day period, for example, before this covered call expires, they're going to what's called call it away. So I get $140 a share, plus I get, let's say, that $1,000 or whatever it might be from selling the call. And I'm okay because I'm trying to prune, or harvest some of the fruit off of this tree. I just got $140 when it was worth 127, right? And if it doesn't get to 140, I just get the $1,000 and I can go do it again the next month. And so I can keep doing covered calls, covered calls, covered calls. And if it never gets to 140, I'm just collecting income off of that piece. Now, this is just a small piece, right, of the total. I'm not trying to sell the whole thing. I'm just trying to gather some fruit off of this tree. And so that's a covered call is just a way for you to generate income. But really what it does for me is it sets a price above where you are right now, where you're going to sell it. And so, with the client, I kind of determine, hey, when it gets to 140, let's, sell a little bit of it. And instead of just putting in an order to do it, I'm going to keep selling these covered calls so I can make money while I'm waiting for it to get there. And if it doesn't get there, I just keep making money as far as that goes. So I do like covered calls. The one risk to a covered call is if what if, during that 1 month, Apple goes crazy and it goes to 160, you're still only going to get 140 out of that sale. So that's a disadvantage. But if I had a sale order in at 140, I'm only going to get 140 anyway. So, that's, and I'm only selling a small portion. Um, so the other thing I would do though, just in case, is I would have that same number of shares where I put in a stop loss. And the stop loss is designed to sell at some price. And so let's just say, looking at this chart right here, I might put a stop loss right down here. And again, it's a bit more complicated than it looks. So I want at or below. And now I've got kind of this bottom piece here. So because I don't want this thing to go, falling apart. I want to harvest that fruit someplace in this range. If it comes above 140, good, we'll take it. If it goes below, it looks like 120, 115 here, give or take. Okay, good, we'll take that too, because we don't want to get too greedy. We don't want that to turn into 90 or, things can happen. And so anyway, that's a way, on a very occasional basis, once a year, twice a year, 3 times a year, where you can kind of harvest some of the fruit and generate a little bit of income, during the period of time that, that you're waiting for that price to happen that you're interested in selling at. So, you got to pay a little capital gain on that, but I had some clients that rode that GE all the way to the bottom, and they ended up with losses. So you just got to be careful. One of the things that does happen is people fall in love with their stocks for obvious reasons. You put in a small amount and it turns into a large amount. You love that, but you just got to be a little careful mentally not to get too attached. Because it can really impact your retirement, especially if it's a big piece of your retirement. So that's
So
that's how I would handle it.
so how is like the income from a covered call taxed compared to like a selling the shares?
Yeah, okay. So if you sell the shares and you've owned them for more than a year, even if they're called away by the covered calls, that's going to be a long-term capital gain, which has a maximum tax of 20%. If you sell a call, so each month that you're selling a call, you're getting some money, and it's different amount depending on how close you are to the price and what stock it is. But that's going to be taxed as just ordinary income. So if you got $1,000, you just add it to your other ordinary income, and that's just part of your taxes. So you're going to lose some of it to tax, but I mean, you never were going to get that $1,000 before, so it's sort of found money. I mean, even if you get to keep 700 of it or something, that's still a pretty good deal.